Good morning, Nick. Thank you very much for taking the time to talk to us. Now, you recently reported your interim results. They showed good progress. Can you just take us briefly through the key drivers?
Yes, good morning, Fiona. Well, we're fairly pleased with the first half results, and we've seen, I would say, a broad-based recovery across the business. All geographies and all sectors are up and improved on last year, which is encouraging. There's been a number of factors driving that. I think the first one is much more normalised levels of activity across most of our client base, with a few obvious category exceptions: travel, leisure, tourism, things like that, which still haven't returned. But a broad-based recovery across the client sector, and enhanced or supported by a good new business performance. That started in Q3 and Q4 of last year, carried on really into Q1, Q2 this year. So we're pleased with the new business performance, some of which last year were the former Accenture clients, and we're seeing the full benefit of that come through. Then there's been a couple of other factors. We've put increased focus this year on what we describe as a universe of higher value strategic clients. That's paying off. Revenue growth from that universe is somewhat ahead of our own budget, so that's encouraging. We're also seeing the revenue growth and benefit of the new productized digital solutions start to make a positive contribution to the bottom line as well as the top line. So there's a number of factors really, and one that we should also be cognizant of is a tailwind in our media management business. There's been an unusually high level of agency selection mandates, really because in 2020, big brand owners that may have put their media business up for tender didn't. You know, they had other things to worry about in 2020. So we're seeing a degree of pent-up demand from 2020 come through to the first half of this year. So we just need to recognise there's a degree of a tailwind in that sector of our business.
What factors do you see coming into play in the second half?
Well, I think there's two themes. The first one is that tailwind that I just described there will start to drop away. It won't fall off a cliff. There is still activity there, but it will taper off a bit. And then the big theme that is really on everybody's minds, not just in our industry, but is out there in the general financial or economic commentary, is about inflation coming through. Where obviously a lot of commentary about input price inflation for many companies. That includes, you know, virtually all our clients, I would say. They have those concerns to manage. And they also have quite significant media inflation to contend with. We're seeing a continued drift away, or in some markets, perhaps a slightly quicker decline of linear television audiences to obviously the subscription-funded streamers, but also in some markets, particularly the United States and also to a degree here in the UK, we're seeing the rise of ad-funded streaming services, video on demand, and audiences are going to those. So we have a decline of linear TV audiences meeting brand marketers investing into the economic recovery and the consumer confidence that we've seen, that excess savings from last year coming to market. So we have a supply and demand equation where supply of audiences is declining, but demand for those audiences is rising. So we're seeing quite a lot of media inflation concerns from clients come through. And that's probably the big theme of the conversations I've been having with clients in September since the start of this month. And it's two sides of the same coin. On the positive side, they're asking for our advice on how they can help mitigate that inflation, and particularly into 2022. But on the other side of the coin, there is a concern that some of these companies, the pressure is going to come down from higher up, chief finance officers, whatever it might be, to reduce budgets in some of the expenditure areas. So there is a degree of uncertainty in that. We're seeing it flow through most notably perhaps in the automotive sector, where we have strong representation. We're strong in the automotive sector, but you know, as you know, everybody knows there are supply chain constraints there, and some of those big manufacturers, BMW and Daimler, which are both clients of ours, have said they're going to limit production and therefore limit advertising. There's no point advertising if consumers can't get cars. So we had good visibility on the second half of the year, but there's a degree of caution in there.
Now, you mentioned earlier on that you've started the rollout of the digital products. What have you rolled out to date, and what's coming up?
Well, the original product, sourcing and monitoring, we effectively view as our proof of concept. In January 2020, there was one client, a foundation client. Through the course of 2020, we onboarded 10 clients. The impact this product was able to make for those clients' businesses was significant, and that encouraged us. And we had further encouragement that the infrastructure we had built was very robust and highly scalable. So on the back of that, we said, okay, let's come up with new productized services that take the same format, ingest vast amounts of data that we clean, aggregate, store, analyze, and provide insights and information on. What other productized solutions can we bring to market? And just in July, we brought 2 new productized solutions to market, one that we call campaign governance, which is similar to sourcing and monitoring, and it'll be an always-on subscription-oriented kind of product. And the other one is audience data assessment, which is designed specifically to address the challenges advertisers face in a world where there's a deprecation of third-party cookies and the removal of identifiers for advertising by Apple. These are the means by which online advertisers have targeted their consumers since the dawn of the internet. With those being removed, there is high levels of concern and anxiety from advertisers about how they can target going forward. So our audience data assessment product is designed to meet their needs there. That is slightly different, and it won't be always on subscription. It'll be about 90 days project, which once sold in, once the work is done, may not need to be repeated for another 12 months. So it's a different type of product there. And the fourth one that we have brought to market, although I would categorize it or characterize it rather as a pilot, is our responsible media investment product. The reason I call it a pilot is because we don't know the level of value it's going to offer to clients. It's a sort of a new pioneering approach, again, designed to address a specific client need. All corporates, as you know, are on a journey, a path to improve their ESG credentials. Much of that is focused around the sourcing of raw materials, various aspects of the supply chain, reducing carbon emissions, impact on the environment, etc., etc. But our clients spend millions, multi-millions of dollars through a media supply chain. And to date, there's been very little oversight, shall we say, in how those dollars are allocated, to whether the media owners have good governance around data protection, consumer consent, consumer privacy. Do they publish fake news? Do they publish hate content, etc., etc.? So we're ingesting lots of different data sources to match that up with our client spend to see if they've got a problem. And we're piloting this with 10 of our largest clients. We'll have the data, full 6 months data at the end of December. We'll review it in January. Depending on what we find there, if it's providing good value to clients, we'll ramp that up.
Now, historically, you've been very strong in some geographies. How do you plan to accelerate the growth in others, and particularly in the US?
Yes, the origins of this business are here in the UK, and the niche segment we occupy is quite mature and well developed in Western Europe. So we are, you could describe ourselves as overweight in the UK and continental Europe, which are more mature, lower growth markets. Our niche segment is much less developed in Asia Pacific. So we see opportunity to grow there, albeit I think it'll be sort of a pace of organically developing the client need. Multinational advertisers buy our services there. We now need to start trying to penetrate the Asian domestic advertisers, which we're making progress on, but I think that's going to be a slower journey. But over in the West, we have been, and really are to date, underweight versus the opportunity there. You look at the US market and the China market together, they represent 50% of the world's advertising market. So we are seeking to accelerate growth in the US. We've had some good new business wins there, made some notable progress. We're growing faster there, albeit off a relatively low base, but we will continue to focus our efforts in the US. And if we can find appropriate acquisition targets and strike the right deals with them, we would like to apply some M&A to our business in the United States.
Thank you very much, Nick.
Thank you. Thank you.